Hi traders, you're welcome back to the Forex Geek channel. In this video, we're going to be diving into one of the most powerful concepts in smart money trading, and that is the order blocks. So if you've ever wondered how the big players move the market and why price reacts at certain levels, then this is the video for you. So by the end of this video, you'll know exactly how to master order blocks to trade like banks, avoid common retail traps, and refine your entries and exits. So if you're serious about improving your trading skills, smash that like button and subscribe to the channel for more expert insights. Now let us get started. First of all, let us just break down what an order block actually is. Right? Order blocks are areas on the chart where institutions, banks, and hedge funds have placed large buy or sell orders, creating, significant levels in the market where price is likely to react. Okay, so unlike traditional support and resistance, order blocks represent actual institutional activity. When smart money enters the market, they don't just place a single order, they distribute their trades in a way that doesn't immediately spike the price. So these zones leave behind footprints on the chart. And once you learn how to identify them, you can align your trades with the market makers instead of getting caught in retail traps. So now that we understand what order blocks are, let us talk about how to actually find them on your charts. Okay, here are the key characteristics of strong order blocks. The first is that they form before a major market move. All right, if you want to find an order block, you're going to be looking at out for important price zones where there was a significant price activity following a sort of stagnation. So if a valid order block is usually the last bullish or bearish candle before a significant price movement. So for example, within this zone, you can see that we actually have a resistance zone around here, right? You can see that we have a resistance zone around here. This was a period of consolidation before we finally had a significant price move, and we had a sell all the way down to this point. Now, before this particular bearish candle that led the breakout, we can see that we had a narrow range. We had a narrow range within this zone. Before a bearish breakout prevailed. So there is a likelihood that an order block might have been around here. Okay. Now another characteristic is that they have high volume and liquidity. Institutions execute large orders at these levels, so price often reacts strongly. You will notice a strong price movement. There is usually a strong reaction when the institutions are involved and they get retested. All right, once the price breaks away from an order block, it often comes back to retest it before continuing in the original direction. Now, we can see that it seemed like we had a retest around here, even though the retest did not exactly get very close to the breakout point, right? This was where the breakout point was, but we had kind of a retest to this point before a continuation in the direction of the breakout. Okay, and they align with other smart money concepts. Okay, now we're talking about how to identify high probability order blocks. Other blocks are even stronger when combined with liquidity grabs, imbalances or trend direction. Okay, so the most important thing is to look for other blocks on higher time frames, like the 4-hour, the daily, or the weekly charts. These are the levels that institutions care about, and they hold much more significance than lower time frame zones. So there are two types of order blocks you need to understand, which are the bullish order blocks and the bearish order blocks. Now, for the bullish order blocks usually form at the bottom of a downtrend before price reverses upward. Like what we can see happen around here, we can see that we had a bullish reversal right after this bearish move, which we just discussed. We had a bullish reversal. Now, an order block might have formed at the bottom of this downtrend. And remember that the order blocks represent areas where institutions placed orders to drive price higher. Now, in this case, it's going to be buy orders. Institutions place buy orders. That's why it's a bullish order block. They place buy orders to drive price higher. Then once price revisits the bullish order block, it often rejects it and moves upward. Now, there is a possibility, right? There is a possibility that there might have been something significant around here, and you can see an upward movement, and you can see a retest, right? You can see a retest of this particular level before we had a continuation in the direction of the bullish reversal. Okay, because once the price revisits the bullish order block, it often rejects it and moves up. Now let's talk about bearish order blocks. Bearish order blocks form at the top of an uptrend, right? As the name implies, it's bearish order block. So of course it forms at the top of an uptrend just before the price reverses down, right? And they represent areas where institutions place sell orders to push the price lower. So when price comes back to retest the bearish order block, it often rejects and drops further, right? So knowing the difference between these two will help you refine your trade setups and avoid taking trades against the institutional trend. So how do banks use order blocks to trap retail traders? This is where things get interesting. Smart money doesn't just place their orders and let price move freely. They manipulate the markets to trap retail traders before making their move. So these are some of the common retail trader traps. The first is fake breakouts. Institutions can push price just beyond key levels to trigger stop losses before reversing. And you can see what happened here. It was possibly a fake breakout that happened around here, because you can see that after a push to the upside, you can see that this was a rejection candle. You can see this long wick here. The price got rejected, and before you know it, after this retest, you can see that the price actually declined. So if you are in a haste to enter a buy trade, perhaps you want to chase a bullish breakout, then you would have gotten stopped out, or you would have been in a significant loss. Now, another retail trader trap is the liquidity grabs. Now, order blocks are usually formed around areas with high liquidity, such as the previous highs or previous lows, where retail traders have their stop losses. Okay, and then these big guys try to take advantage of that, and that's the reason why we have something called stop hunts. Yeah, so they might push the price to significant areas where pending orders are set and stop losses are set, and after triggering the stop losses, you will notice a reversal back in the direction of the initially intended trend, right? So apart from that, false support and resistance zones are also common retail trader traps. Many traders rely on traditional support and resistance without realizing that order blocks hold more weight. So what's the key takeaway here? Don't chase breakouts blindly, okay? Wait for price to return to an order block and confirm the move before entering a trade. Now, this is how you stay on the right side of the market. Now that we know how to identify order blocks and avoid retail traps, let us talk about how to actually trade them. Now, for our entry strategy, you have to be watching out for a retest, okay? The order block retest trade. You identify a strong order block on a higher time frame, right? Then you wait for price to break away from the order block and return for a retest. Then you look for confirmation signals like candlestick patterns, right? Bearish candlestick patterns around the resistance zone, or bullish candlestick patterns around the support zone, right? And then you enter the trade with a stop loss beyond the order block, and you target the next liquidity zone for your take profit. All right. Then you can also use confirmation tools, okay? Perhaps fair value gaps, your imbalances, and because price often moves toward other blocks to fill liquidity voids. For example, we can see that in this area where we had, you can see this long bullish candle. You can see the distance between here and here. We are eventually had price come down to fill that void, right? Or rather, to fill up that space, right? That space of that significant move between this candle and the next candle, okay? Then also watch out for divergence. If price approaches an order block, while indicators like maybe the RSI show divergence, it is a strong signal. Okay, remember, the divergence is when price is moving in a specific direction, perhaps making lower lows, while you have the indicator making higher lows. That's what we call a bullish divergence. Or when you have price making uh, higher highs and you have the indicator making lower highs, this is what we call a bearish divergence. So pay attention to divergence as well. And then look out for liquidity sweeps. If price stops out retail traders before hitting an order block, it's even more likely to hold. Okay, so trading order blocks is not about guessing, it's about following the footprints of smart money and letting the market show you where to enter. All right, traders, that is a wrap. Now you have everything you need to master order blocks to trade like banks and align your trades with smart money movements. If you found this video helpful, hit that like button and subscribe for more in-depth trading strategies. Drop a comment below if you have any questions or if you want me to cover another topic in detail. And don't forget to turn on notifications so you never miss an update. See you in the next video. Trade smart and stay disciplined.